Good afternoon, everybody. Welcome to our first quarter, webinar, our second webinar of the year. Why don't we get started here? I know a few people are still going to be rolling in, but by the time we get to our disclaimers, we'll probably have everybody in and ready to go. We're joined today by Joe Basque, most of you know, out of our Qualicum Beach office, and there's a new face on the screen today, which is Damir Alnzour, who joined us about a year ago. He is in our Toronto office, and he is going to be presenting the webinar with me today. Matt is on holidays with his family, and so he will not be joining us. So, Damir, welcome. Thanks for joining us.
Thank you, Lorenzo. Happy to be here, and thanks everybody on this webinar for joining as well.
How's Damir's volume for you, Joe? Was it a bit quiet?
Can we do one more little test there, Damir? It sounded okay.
Yeah, can you hear me okay?
Yeah, I can hear him okay.
Yeah, okay, perfect.
Okay.
Let's get into it. Okay, guys, just a quick disclaimer as always before we get going. Today you're going to hear Damir and I present some opinions on our views on the markets. Those are not the opinions of the firm. They should also be characterized as an investment advice. They're presented for information purposes only. Sometimes we, prognosticate about what we think might happen in the future or where things may go. These are known as forward-looking statements, and of course, they're just kind of our guesses and our opinions, and they should not be taken for fact. We do discuss alternative investments in the presentation today, and alternative investments may not be suitable for all investors and may confer a higher degree of risk, especially around liquidity for investors. And lastly, Westmount Wealth is a registered portfolio manager in BC, Alberta, and Ontario. All right, let's get into it. Damir, why don't you start off by telling us, what are the three themes that we saw in the first 3 months of this year?
Yeah, thanks, Lorenzo. So yeah, let's get right into it. What actually happened in the first quarter? The short answer is that Q1 2026 was a reminder that markets are not driven solely by economic fundamentals. Instead, we saw a combination of external shocks and shifting expectations that took center stage and quite frankly caught many market participants off guard. Rather than a smooth continuation of what we saw in 2023, 24, and 25, which were fantastic years in the stock market, Q1 introduced a new layer of complexity that we need to carefully manage as your portfolio managers, and quite frankly, as investors alongside you, our clients. So what does that mean, or what are the key themes that we saw in the first quarter? Well, there's obviously the elephant in the room, which is the conflict between Israel, Iran, and the US, and that escalation in the Middle East. And that is significant, not just because of the human toll that quite frankly cannot be overstated, but also because of the direct economic impact that energy prices have on everyday consumer goods and even business input costs. The second theme that we saw play out during this quarter was the shift in global growth expectations as it relates to that conflict and those exogenous shocks, which has put central banks in a very difficult position, which we'll talk about a little bit more in depth in a few slides. And then the third key theme is a continuation theme, which we discussed in the last few webinars, which is a meaningful transition in how markets are evaluating AI-related investments. The narrative is shifting from excitement about AI spending and maybe a little bit of exuberance to a more disciplined focus on return on investment. Crucially, I would say that those three themes that you're looking at here interact with each other. They are not isolated stories, meaning that rising energy prices complicate inflation outlook, which in turn complicates central banking policy, which then affects the valuation of some of those growth tech stocks that we're going to talk about. The interconnectedness is why the current environment may feel more uncertain than it did just a few months ago. Having said all this, let's dive into the Middle East conflict and focus on that first. As I'm sure most of you are well aware, there's been an escalating conflict, obviously, in the Middle East, as I mentioned, specifically around the Strait of Hormuz, which is a very important geographical energy choke point. About 20% of global oil supply and 25% of liquid natural gas supply passes through the Strait of Hormuz. Why does this matter? Well, because basically energy markets price in uncertainty fairly quickly, and energy is one of the fastest channels through which geopolitical risk translates into real economic impact. In effect, basically higher energy prices, they act like a hidden tax on consumers and businesses. When you are paying more to heat your home, to fill your car, to buy groceries, that is money that is no longer available for other forms of spending. Now, what does that really look like when we take a step back and look at history? So I'll walk you really quickly through 3 prior events where we saw oil or energy supply shocks. And the first one is the 1973 OPEC oil embargo. And that one was a fairly long-lasting one in that the impact of that event basically played out through the 70s into the early 80s. There was effectively a cutoff of oil exports when the US, Israel, and Arab nations, or Arab nations and Israel for the most part, had a conflict. And that caused fuel shortages and global economic uncertainty. And then we saw rising inflation and higher rates into the early 80s. By contrast, in the 1990s, we saw the first Gulf War when Iraq invaded Kuwait, and then the US got involved. And that's destabilized markets for about a few months until things recovered. And then the last event that we saw somewhat recently was in 2019, when there was an attack by the Yemeni Houthi rebels on Saudi oil facilities, and that disruption was contained within a few weeks. The lesson here is pretty straightforward. Rather than reacting to the shock of a headline, the more important question to ask ourselves is whether the disruption is sustained. This is what ultimately drives long-term impact. The situation today is very much still unfolding, and I would say its severity is yet to be determined. So it's TBD. Now, if we take another step back and we look at other types of geopolitical events over the last, almost 75 years here, going all the way back to 1950 to the Korean War, and then we look at the return of U.S. equities, so the largest 500 U.S. stocks, the S&P 500, 1 year after the start of that geopolitical event or shock, you'll notice that in most of those cases, markets actually delivered pretty robust returns 12 months thereafter. Not positive in all instances, not by any stretch of the imagination, but the average return across all those geopolitical events was an annualized rate of return of 14.2%. So the point is that the first reaction is often fear, but disciplined long-term investing is handsomely compensated over long periods of time. Because ultimately, you're getting paid to bear that volatility and the risk, right? If you couldn't handle any risk, then all you can expect realistically is a risk-free rate of return or the return on your savings account. Having said all this, what do we do within our portfolios to help dampen some of that inflationary shock and those geopolitical risks? Well, we take a multi-layered approach to building an inflation-resilient portfolio. For example, in our Westmount Real Asset Fund, we have some inflation shock absorbers. So just as an example, we hold the Picton Inflation Opportunities Fund, and that holds some commodities inflation-linked strategies, and those typically respond quickly to inflation. We hold some real assets and infrastructure. The income and cash flows from those assets is typically indexed or linked to inflation as well. And then we hold some hard real assets like farmland and timberland. And as the cost of fertilizers and input costs go up, typically, price of groceries, et cetera, goes up, and agriculture and land prices tend to follow and benefit from that. The point is we're trying to build a somewhat inflation-resilient portfolio that provides you with more stable returns when inevitably geopolitical shocks happen, and that provides you with a smoother ride towards attaining your goals. That's what we really focus on in our portfolio construction. So having said all that, I'll pass it. Oh, actually, sorry, just a quick reminder and a wrap up here. Key takeaways from this section: short-term volatility is to be expected. Markets often recover after that short-term volatility. The real risk is prolonged geopolitical risk, and we don't know how that's going to play out, to be determined. Diversification is your friend. Avoid crystallizing losses and being impulsive around your portfolio decision making. If you have short-term needs, please reach out to us or your dedicated portfolio manager. And the last thing I will say, and this is something that you often hear, is don't just stand there, do something. Well, we would actually urge you to do the opposite of that. Don't just do something, stand there, because choosing to do nothing is in itself a form of action, And it's typically the right form of action when you're feeling like you need to do something impulsively to take back control. So having said all that, I'll pass it to Lorenzo to talk about the global growth expectations and central bank policies.
Perfect. So, the second major theme we've been seeing here is the change in sentiment about whether or not the, monetary policy easing that we've seen over the last 2 years that started in 2024 is going to continue. Obviously, we remember in 2022, 2023, interest rates spiked, pretty dramatically to try and deal with, the inflation that we were seeing. And then since then, we've seen central banks in Canada and the US, also in Europe, but we're talking here about North America, cut rates slowly over that period of time. The thinking was at the beginning of this year, we're going to probably see some more rate cuts into 2026. But, that narrative has been complicated by the fact that the geopolitical, events that we're seeing in the Middle East are, have caused oil prices to spike, and obviously increasing energy prices often materially impact inflation. And so, what you have right now is, the central banks in Canada and the US really facing a dilemma, because you're seeing reasons why to lower rates and also reasons why not to lower interest rates. So on the former category, we're seeing growth slowing. Consumer spending, when consumers are nervous, they're going to spend less. Spending less weakens GDP. We've been seeing some rising unemployment in a few categories. We're seeing that, the housing market, as all of us know, is still weak. Weakness started in late 2022 and hasn't really picked up, at this point still. And obviously a lot of geopolitical uncertainty around not just the war in Ukraine, but now the war, with Iran. On the other side of the equation, we're seeing inflation risk rising, and that would make central banks not want to lower rates. We're seeing, energy prices increasing, supply chain disruptions, obviously, certain sectors of the industry, certain industrial sectors are seeing, inflation that has been pretty sticky. And obviously, since Trump started his tariff war last year, there's a lot of limbo in terms of tariff policy, and there's concerns that obviously that might lead to reasons why central banks might want to just keep rates where they are right now. So I think, the general sentiment is probably a pause at this point for more clarity, but what it may mean is that we're probably not going to see the, rate cuts that were anticipated earlier in the year. What does that mean for your portfolio? Well, those of us who might be on a variable mortgage, might not get those, rate cut benefits that we were hoping for, or if you've got a fixed mortgage that you're renewing later on this year, again, you might, be paying higher rates than you might have been hoping for as a result. Interest rate uncertainty often leads to bond price volatility, but it also lead to, equity valuations becoming more dependent on headlines as opposed to maybe some more fundamentals. And the big thing really, I think that this all boils down to with this uncertainty over growth and concern over inflation is discussion of stagflation. Now, those of us who were old enough to remember the 1970s will probably remember that was really the major concern and the major problem that North America dealt with in that time. That OPEC oil crisis was so dramatic that it caused economic growth, contraction, so GDP contracting at the same time as prices surging. And obviously that is the situation that most economists are keen to avoid. So there's been a fair bit of chatter about stagflation in the last few months. So Damir, that does a lot of the research and analysis on our portfolios. We asked him about a month ago when we were starting to prepare for this presentation, can we find some data looking back, 50, 100 years to see, how stock markets perform, in periods of stagflation. And the first thing I want to say about that is that, as we've often commented to clients in these webinars or in client meetings, the economy and the stock market can be thought of as cousins, sometimes distant cousins. They're not brothers, right? The economy is reflecting what's happening today. The stock market is normally looking 6, 12, 18 months ahead to where they think, the economy is going. And so very often we see the stock market is doing well in periods of time when, the economy might not be doing as strongly. What was very interesting in the data that Demir pulled, and we've managed to find 95 years of data. Now, this is US data, to be clear. So in the US, essentially, if you want to categorize each calendar year in one of four buckets, the most unattractive of those buckets being a stagflationary environment, we saw 12 years, essentially, out of 95 years where the US experienced stagflation. 75% of the time in those 12 years, so 9 out of those 12 years, the S&P 500 showed positive real returns. By real returns, we mean net of inflation. So if the stock market did 10% and inflation was 3%, it means that the real return was 7% on that. So interestingly enough, not only were most years positive, but the actual average rate of return in that period of time was very strong, at 16.4% per year, the average of those 12 years. Now, we don't know, obviously, if history will repeat itself, but it is interesting to note, and certainly the historical evidence over the last 95 years bears out that sometimes stagflation environments don't necessarily have to be bad, for the stock market. So, the big takeaway here for us in terms of like this big theme in the quarter is that, when it comes to diversification, and we talk about the importance of diversifying a portfolio, one can think of diversification through multiple lenses. The most simplistic way that we often think about it is to say, okay, well, I have different types of investments. So I'm investing in stocks or bonds or real estate or infrastructure, or music royalties, and you can kind of think of those different categories of investments as a form of diversification. A more sophisticated layer of thinking about it on top of that is to think about not just different asset classes, but what are the sensitivities of those asset classes? And what do I mean by that? I mean, for example, how do they react to inflation or interest rate shocks or equity market downturns? Do they behave in tandem? And so you might think you're diversified, but you're not actually diversified. So for example, dividend paying stocks, government bonds, and core real estate all tend to be three asset classes that are very interest rate sensitive. So you might think you're diversified, but if all of the investments you hold have similar factor sensitivities, you're not really protecting your portfolio as much. So we've been working hard, as Demir was talking about above, with some of the positions of the real asset funds, to layer in more positions in the portfolio to help protect against that particular sensitivity, which is a current concern for us right now.
All right, so let's turn into artificial intelligence, which obviously continues to be a significant structural theme for markets. I mean, we've been talking about AI for the last few webinars, and it's a continuation of that conversation. We're very much still in a phase of capital investment, so a lot of money is going into artificial intelligence. It's mostly an infrastructure build-out story around data centers, semiconductors to energy supply, and it's proceeding at a pretty unprecedented pace. So let's take a look at what that's looked like over the last few years. If we look at AI spending over the last few years, obviously you see it accelerating. The spend is expected to exceed 500 billion in 2026, or roughly 75% of that will be tied to infrastructure specifically. And it's worthwhile noting, however, that even though the spend is going up, the rate of spend is actually starting to slow down. So year-over-year growth is likely going to be about 25%. Having said that, it's still very robust growth. There's still a lot of spending in this space. And again, it's mostly driven through data centers, which are driving enormous energy demand, which creates another interesting connection back to our earlier discussion about energy prices and infrastructure constraints. Having said that, the story and the sentiment is slowly shifting, right? Investors are starting to think about, well, okay, we see this surge in spending, but that doesn't necessarily or automatically mean or translate into proportional profits or returns to investors. So we're seeing that shift in sentiment in terms of, well, previously we're thinking AI is going to change everything, invest in anything related to it, or a lot of market participants were thinking about it that way. Now it's becoming more of a show me the money story or show me the earnings. Anybody watch Jerry Maguire, remembers Tom Cruise in that movie yelling, show me the money on the phone? That's basically what's happening in the AI space and in the tech side of the market. And it makes sense, right? Because all this money went in, nobody knows the exact future payoff and when that will materialize and what it's going to look like. So we're transitioning from that capital deployment story to an earnings validation story. And the next phase will be probably defined by that return on investment, not just who spends more money in this space. So having said that, we know that currently the big winners in the AI space, or at least until recently, have been the large hyperscalers. So those are Microsoft, Amazons, the Googles of the world, and the enablers, which are building the chips like NVIDIA and AMD. So winners are fairly clear or have been clear up to this point. But the potential next phase is actually pretty interesting. As AI gets broader adoption in the economy across many other different sectors, we're moving from experimentation in the use of artificial intelligence to real world implementation. And even our business, we're starting to use AI for certain parts of what we do on a day-to-day basis in terms of workflow processes, et cetera. And that's driving up our productivity and efficiencies, to be quite frank. So it becomes a really interesting story. And what does this mean for portfolios? Well, we're not thinking of AI as a single tech trade. So we're trying to avoid over concentration. We are thinking of AI as a structural long-term opportunity. So eventually, if it gets incorporated into, let's say, industrial sector, healthcare, energy, financial services, that could potentially reduce costs over time, enhance productivity, and enable better workflows. So it should be thought about as a multi-cycle, multi-sector theme rather than a single concentrated tech sector bet. And the current trends in AI basically reinforce the need to participate in this structural innovation without over-concentrating on the risk factor. So I'll pass it to Lorenzo again, just to give us a quick recap of all these themes, and then we'll move on to what actually happened in terms of asset class returns in Q1.
I think one of the biggest mistakes we can make as investment advisors is to put too much stock in our own theories about what's going to happen in the future. History is a great humbler of all of us, and the world changes unexpectedly all the time. And I think nowhere is that clearer than if we just look at the last 3 months and how much the story has changed. The beginning of the year, we were talking about disinflation and rate cuts. Now we're talking about energy shocks and interest rates being higher for longer. We'd seen a few years of really stable growth being really driven by AI rallies. And now we've got a lot of geopolitical uncertainty that is putting question marks on growth. So again, the key is to always, try and protect and diversify, not just in terms of types of assets, but in terms of risk sensitivities in the portfolio. And that's what we feel our job is as investment advisors for clients, to try and build portfolios that are as stable as possible over different types of economic environments that we see. So let's take a quick look now at each of the various asset classes and how they did for you over the last quarter.
So I'd say importantly, before I dive into this slide, despite all the challenges that we saw in the market, markets actually largely held their ground. I want to be candid that returns year to date are perhaps below our long-term expectations, return expectations, especially if you compare that to 2023, 24, 25, that were stellar years in the market. And I'd say as investors, we all suffer from recency bias. We tend to extrapolate. So when markets do good, we expect that those returns will continue and that everything will continue to go gangbusters. And then we become very despondent when we don't see good returns over a short period of time. My maybe point of view and something I'd implore you to do is to try to remain as level-headed as possible as long-term investors. So don't get too despondent when things are not going the right way over short periods of time, but don't also get too excited when things are great. Much easier said than done. I completely appreciate that. So let's look at commodity performance in the first quarter, and not surprising, oil price, you see this at the gas station, at the pump, way up due to the geopolitical uncertainty. Surprisingly, gold and silver, and gold is typically talked about as a safe haven asset. We saw them go up, but then when the conflict started, they actually retraced a lot of that growth during the quarter. So, maybe a bit surprising, but again, gold is not always that safe haven asset that everyone, usually trumpets or talks about. The other alternative gold asset that people talk about is crypto. And just for reference, crypto was down, or specifically Bitcoin to be precise, was down 22% in Q1. So again, didn't quite, hold up. It's really a risk-on asset for the most part, or that's how it's at least historically behaved. And then natural gas, some people find this surprising, but it was actually down 20% on the quarter. Some folks think that natural gas and oil go up together or move in tandem. Not necessarily so. Natural gas typically goes up with weather patterns, heating needs, also LNG supply and storage. So, they don't necessarily move together over time.
One of the headlines, the headline really of the last 3 years, when we take a look at, U.S. markets, has been the effect of, the Magnificent Seven. I know they've gone by many names in the past, FANG. There's probably 4 or 5 names that in the last 10 years what we're calling like the big tech companies in the U.S. Right now they're called the Magnificent Seven. And we've seen a lot of growth expectation built into the stock prices because, these were companies that were the best positioned to benefit from artificial intelligence. And these are the companies that have been spending hundreds of millions of dollars building AI centers and the capabilities to deliver AI. The challenge, obviously, of that is that when you have a lot of growth built into the stock, the price of a stock, that stock becomes very sensitive to bad news. And if the earnings aren't delivering in the same way that people expect they are, then you could see very, rapid falls from grace, if you will. And, we've started to see things taper out a bit last year. And certainly this year, I think the narrative is much more about, earnings growth and concerns about spending, and the speed of spending seems to be modulating a bit from a percentage basis, even if the nominal amount is going up. But it wasn't a good quarter for the Magnificent Seven. Microsoft down 23%, Tesla down 17%. And if you remember, about 2 years ago, one of the changes that we made to the portfolio is that we took about 30% of our exposure to the US and made it from market cap weight to equal weight. What does that mean? Well, normally how we invest when we invest in Canada, the US, and the international markets is that we basically own the index with a very low cost exchange traded vehicle, and we own it in a proportional sense. So if a company like Microsoft is, let's say, 4% of the S&P 500, then it's 4% of that ETF. And as it grows, that percentage position grows. Obviously, the biggest name, so we talked a lot in the last year or two, how the biggest 7 companies now represent they did about 3 months ago, I haven't checked the data recently, about 40% of the S&P 500. What it means is that the price of the S&P 500 is very sensitive to movements in those big 7 companies because they represent 40% of the total value of that index. So what we decided to do is we took about 30% of the position in the US, and we purchased an equal weight S&P 500 index, which means that every single stock only had a 0.2% weight. The idea behind that was that we were a bit worried about how exuberant the pricing had become with those tech companies, and that if we saw a retracement, that would be a bit better protected for clients. And that is exactly what we saw happen in the last quarter. We take a look at each of the 4 exchange traded funds with equity positions for clients that we hold. You get the same story that we saw last year continued into this year, and that was that international developed market stocks and Canadian stocks outperformed US equities. And that's really the first time we've seen that in quite a number of years. The narrative really up until 2024 was that US equities were the predominant driver of global stock market returns, and we've seen that that's modulating. You can see international markets developed about 4.2%, Canadian equities in terms of our holding up about 4%. The equal weight position in the US we hold through EQL was essentially flat, whereas the VUN position, which is Vanguard's all equity ETF position, was down about 3%. So that defensive 30% that we added in certainly helped protect on the downside there. Do you want to take us through the fixed income?
Yeah, absolutely. So just turning into fixed income, the bond sleeve of our models delivered a fairly small negative contribution in Q1. Given rising inflation expectations and uncertainty, honestly, it's a fairly decent outcome because typically when inflation expectations rise, there are fears of interest rates going up as well. And when interest rates go up, typically bond prices come down. So it's an inverse relationship. So given that environment, fixed income actually held up pretty well. And within fixed income, we actually diversify a lot across global bonds, Canadian corporate credit, and alternative bond strategies. So those are the three strategies that you're seeing here on the screen. Another thing, just to remind folks, what is the role of bonds in a portfolio, is to be significantly less volatile than stocks. So I want to point you to the y-axis of this graph, and you'll see that it's from -2 to 1, basically. That's this whole move that you're seeing on the screen. It's about a 3% move. If I go back one slide and I look at the y-axis for equities, we're looking at 12% to -6%. That's an 18% spread. So when we talk about fixed income and volatility and how it acts as a dampener, but obviously has a lower expected rate of return than stocks, that's what we mean. Look, the bonds are not designed, they're not there to shoot the lights out. They're there to give you a steady, smoother ride that delivers consistent income over time and meets your short and medium term needs. That's the role of that asset class within your globally diversified portfolio. So that's it for bonds. Moving on to our alternative investments. And you'll notice here that, actually, before I dive into the slide, first thing I need to disclose for the sake of intellectual honesty is that we're looking at the 3 months from basically November 30th or December 1st to the end of February. So we're looking at 3 months, but lagged by 1 month. And the reason is because a lot of private assets are usually valued with a lag. So for the most part, we're looking at the most recent available data here on this slide for most of these funds. Our alternative income fund and the real asset fund actually held up fairly well in Q1. While U.S. equities, for example, were negative, they posted positive returns. Private equity remains a bit of a challenged space in the markets, and quite frankly, that's not surprising, considering all the volatility and the risk geopolitically, the lower or the slower M&A activity, and the reduced number of exit opportunities for a lot of these companies in terms of going from being private to being public and paying back private equity investors those investments over time. Having said that, I want to just re-emphasize that we still think that private equity plays a role in our portfolio construction. Private equity still is expected to deliver, strong risk-adjusted returns over long holding periods of time, and it still adds diversification and expands our investment universe relative to just holding public equities. So disappointing quarter for private equity, but that happens. 1 quarter doesn't change our long-term holding and diversification strategy.
Absolutely, and thanks for kind of separating those two out, because when we think about private investments, they're not the same thing, right? Normally we think about, as we mentioned in the past, 3 different purposes for holding private investments. One is augmenting income. So instead of just getting dividends from stocks or your coupons from your bonds, what about if you're getting income from music royalties or private mortgages or lending to businesses with private credit? And so that's one form, and that's really what's captured by the alternative income fund. The other part of it is kind of diversifying against equity market risk or equity market beta, if you will. So we look at things like real estate or infrastructure or market neutral positions or inflation protection strategies, and that's part of our real asset bucket. And the third bucket is an enhanced growth strategy. So the third strategy is primarily private equity, and here we expect volatility. Here over time we have the higher risk asset class, but it should yield higher returns. But I would categorize that separately than the first two. The first two are really meant to be the augmented income and the diversification strategy. They're supposed to be volatility dampeners. They're a way, ideally, they're another ballast in the portfolio in addition to your fixed income that's supposed to keep things on an even keel. And since we've launched these funds in 2022, we have seen them do exactly that in a wide variety of environments, from the difficult time periods in bonds 2022 all the way up to this quarter. And so I would say they're doing what they're supposed to be in the portfolio, even if the private equity side of things is not delivering the way we want to right now, because private equity has been challenged for the last 2 to 3 years.
Yeah, and sorry, not to belabor this point, I just want to also remind our clients here that private equity exposure in our core model is held at 3%, and our growth model is held at around 7%. So balanced investors and more conservative investors don't have any exposure to private equity, and it's only really appropriate for investors who have a higher tolerance for an appetite for volatility and risk.
Absolutely. So, just to recap here today to finish things off, I would say that we are experiencing a bit of, elevated uncertainty, especially geopolitically right now in the world, but it's not something that's unusual or unprecedented. Almost every given year will give us things to worry about, whether it's currency crises somewhere in the world, wars somewhere else, banks imploding or having runs. Every year has its own challenges. The key, as always, is to try and spread the risk out, not just by asset class, but in terms of factor sensitivities. And critically, as those of you who've worked with us for a while will know, we don't manage money in isolation or in a vacuum. It's always about how does your need for that money, how do your planning objectives fit into how your money is being managed? Because we're really managing to a plan, to a time frame, to your goals. And as long as we're still on the right trajectory and providing, that growth for you that you need to achieve your objectives, then things are fine. All the rest in the short term, obviously, is just noise. And obviously easier to say than do when it's experiencing tough times in the markets, but always a good thing to remind us. That's it for today's prepared portion of the presentation.